Most Americans think the IRS is out to take their money, but if you actually read the tax code, you find something insane. There are entire sections written specifically to pay you for making certain investments. Not tax breaks, not loopholes. The government literally hands you money when you put your dollars into the things they want built. I am going to show you exactly which investments the IRS pays you to make, how much they pay, why 90% of Americans never touch a single one of them, and how the wealthy have quietly been using these strategies for the last 100 years to build the kind of generational wealth that most people believe is impossible without being born into it. By the end of this video, you are going to understand the tax code not as a tool of oppression, but as a menu that Congress wrote specifically to reward certain behaviors. And if you just pick the items from that menu, the IRS will pay you to live the life the government wants you to live. Let me start with the single most important concept in the entire tax code, because if you understand this one thing, everything else becomes obvious. The tax code is not designed to be fair. It is designed to incentivize behavior. Every single line item in the tax code was written by Congress to steer money towards something. Housing, energy, business investment, retirement, education, charity. If you do what the tax code wants you to do, the tax code will subsidize you. If you ignore the tax code and just work a W-2 job and collect a paycheck, you pay the highest effective tax rate in the country. The average W-2 employee pays something between 25 and 37% of their income in federal taxes, state taxes, payroll taxes, and hidden fees. The average wealthy American pays closer to 15%, not because they have better accountants, but because they understand the code is a menu, and they ordered off the right part of the menu. Now let me walk you through the investments the IRS actively pays you to make. The first one is so simple, it makes people angry when they finally understand it. Start a business. The moment you have a legitimate business, every economic relationship in your life changes. Every laptop you buy, every phone you use for work, every trip you take for a client, every meal you eat while meeting a prospect, every mile you drive between appointments, every subscription you use to run your operation, every dollar you spend educating yourself about your industry, all of it becomes deductible. And I am not talking about some small percentage. Under Section 179 of the tax code, you can write off up to $1 million of business equipment in the same year you buy it. A regular employee making $100,000 pays taxes on $100,000. A business owner making the same $100,000 can legally deduct tens of thousands of dollars in expenses before the IRS ever sees a penny. That is not a trick. That is the tax code working exactly as it was written. Congress wants more small businesses in America. They wrote the rules so that the more you invest back into your business, the less you pay in taxes. And it compounds over time. A business owner who invests aggressively in their operation can legally run at a paper loss for years while actually building real equity and real cash flow underneath. That is the game. The second investment the IRS pays you to make is real estate. And I want to spend real time on this one because this is where the wealthy quietly build generational money. When you buy a rental property, the IRS lets you deduct something called depreciation. Here's how it works. The tax code assumes that the physical structure of a building slowly wears out and loses value over time. For residential property, the assumed lifespan is 27 and 1 to 2 years. For commercial property, it is 39 years. So, the IRS lets you take the value of the building, divide it by that number, and write it off against your income every single year. A $500,000 rental property with a $400,000 building value gives you roughly $14,500 in depreciation deductions every year for nearly 3 decades. That is $14,500 of income that the IRS pretends you did not earn even though you did. But here's the part that will blow your mind. The property is not actually losing value in most cases. In fact, it is usually going up. So, you are collecting rent, you are building equity, you are watching the property appreciate, and the IRS is still cutting your taxable income by tens of thousands of dollars a year based on a fictional depreciation that is not really happening. This is called a phantom loss. It is a loss on paper that is actually a gain in reality. It is one of the most beautiful accounting arrangements in the entire tax code. Now combine that with something called a cost segregation study. This is where a professional engineer looks at your property and identifies every component that has a shorter useful life than the building itself. Things like carpeting, appliances, light fixtures, landscaping, and parking lot surfaces. Those components can be depreciated over 5, 7, or 15 years instead of 27, which means you can front-load huge amounts of depreciation into the early years of ownership. A smart investor with $1 million rental can legally claim $150,000 to $250,000 of depreciation in the first year alone. That is a massive deduction against active income if you qualify as a real estate professional. And then we get to the 131 exchange. Section 131 of the tax code says that if you sell one investment property and roll all the proceeds into another investment property within a specific window of time, you do not have to pay a single dollar of capital gains tax on the sale. You can do this infinite times. You can buy a small rental, sell it, roll the profit into a bigger rental, sell that one, roll the profit into an even bigger one, and keep going forever. You never pay the tax. And when you die, your heirs inherit the property at what is called a stepped-up basis, which means all those decades of gains are completely wiped out for tax purposes. The government literally lets the wealthy build and transfer real estate empires without ever paying capital gains tax on any of it. This is not illegal, it is not a secret, it is written directly into the code. Most people just never read the code. Now, let me move to the third investment, because this one almost nobody talks about. And when I explain it, you are going to understand why the wealthy are so quiet about it. Energy. The federal government wants American energy production. They want it so badly that they created tax incentives so aggressive they almost sound fake when you first hear about them. If you invest in oil and gas through what is called a working interest, you can deduct between 65 and 80% of your investment in the very first year through something called intangible drilling costs. Let me put that in real numbers. If you put $100,000 into the right energy project, you can legally write off up to $80,000 against your active income immediately. Not spread over years, not phased in, immediately in the first tax year. This is one of the only investments in the entire tax code that lets you deduct against W-2 income. It is specifically carved out for this exact purpose, because Congress wants private capital to fund American energy. And clears throat, if you prefer renewables, the solar investment tax credit gives you 30% of your installation cost back as a direct credit. I want to be very clear about what a credit is, because a credit and a deduction are two completely different animals. A deduction reduces your taxable income. A credit reduces your tax bill dollar for dollar. If you owe the IRS $20,000 and you get a $10,000 tax credit, your bill drops to $10,000. It is direct money off the top. So if you install a $100,000 solar system on your property, you get $30,000 back, not as a refund of your expenses, but as a reduction of what you owe in taxes. And you still own the solar system, which generates electricity that either saves you money or gets sold back to the grid. That is the government paying you to own energy production. There are also tax credits for wind energy, geothermal systems, battery storage, and even for buying certain electric vehicles. The Inflation Reduction Act, despite its misleading name, was actually one of the largest packages of energy investment tax credits in American history. It just was not marketed to regular people. It was designed for companies and wealthy investors who would know how to use it, and that is the theme of this entire video. The tax code rewards people who know how to use it, and it ignores people who do not even know it exists. The fourth investment category is retirement accounts. And I know everyone has heard of retirement accounts, but almost nobody uses them correctly. A regular 401k lets you defer about $23,000 a year. In 2026, that is the standard employee contribution limit. But here's where it gets interesting. If you own a business, even a small side business, you can open a solo 401k and contribute up to $69,000 in a single year. That is 3 times the limit of a regular employee account. You are contributing both as the employee and as the employer at the same time. And every single dollar of that contribution comes directly off your taxable income. A business owner making $200,000 can contribute $69,000 to their solo 401k and immediately reduce their taxable income to $131,000. At a 32% tax bracket, that is over $22,000 in tax savings in a single year, every year, for the rest of your career. And then, there is the crown jewel of the entire retirement system, the health savings account. The HSA is the only account in the entire United States tax code that gives you a triple tax advantage. Money goes in tax-free, money grows tax-free, money comes out tax-free when used for qualified medical expenses. There is literally no other account in the entire code that gives you all three of those benefits at the same time. Traditional 401k gives you tax-free going in and tax-free growth, but you pay taxes coming out. A Roth IRA gives you tax-free growth and tax-free coming out, but you pay taxes going in. An HSA is the only one that gives you all three. And here's the twist that almost no one uses. You do not have to withdraw the money for medical expenses at the time you incur them. You can pay medical expenses out of pocket, keep the receipts, let your HSA grow for decades, and then reimburse yourself later at any point in the future. Which means the HSA can secretly function as an additional retirement account with the best tax treatment of any account in existence. Now, I want to go beyond the four main categories because the tax code is full of smaller, lesser-known strategies that can stack on top of each other and compound your savings. Let me walk you through a few of the ones the wealthy use that almost no one talks about in public. First, opportunity zones. This was created in 2017 and it is insane. If you take capital gains from any investment, stocks, real estate, crypto, business sale, and you reinvest those gains into a designated opportunity zone fund, you get to defer the capital gains tax on the original investment until 2026. And if you hold the new investment for 10 years, every single dollar of gain on the new investment is completely tax-free, forever. No capital gains tax at all on a 10-year hold. This was designed to direct private capital into economically distressed areas, but the wealthy have used it to build multi-million-dollar tax-free investment portfolios. Second, the Augusta Rule, which is Section 280A of the tax code. This is a rule that says you can rent your personal residence to anyone, including your own business, for up to 14 days per year and collect the rent completely tax-free. Not reduced tax, not lower tax, zero tax. If you own a business and you hold quarterly meetings at your own home, you can pay yourself $2,000 a day in rent, claim a full business deduction, and personally collect $28,000 a year tax-free. It is one of the cleanest and most underused strategies in the entire code, and it is completely legal as long as the rent is reasonable and documented. Third, hiring your children. If you own a business and you have children, you can pay them a reasonable wage for actual work performed in the business. Under current rules, children under 18 working in a parent-owned business do not have to pay payroll taxes, and if their total wages stay under the standard deduction, they pay zero federal income tax on those earnings. So, you shift income from your high tax bracket to their zero tax bracket, get a full business deduction on the wages, and transfer wealth to the next generation while they learn real skills. A family with 2 kids can legally move $30,000 a year off the parent's tax return this way. Fourth, qualified small business stock, which is Section 1202. If you invest in or found a qualifying small business and hold the shares for at least 5 years, you can exclude up to $10 million of gains from federal taxes. Not reduced, exclude completely. This is one of the reasons so many Silicon Valley founders pay almost no tax when they exit. They qualified under Section 1202, and the first $10 million of their gain is wiped out before the IRS even gets to see it. Fifth, the step up in basis at death. When you die, your heirs inherit your assets at the fair market value on the day you died, not at the price you originally paid. This means all the capital gains you built up during your lifetime disappear completely for your heirs. Someone who bought stock at $10 a share and watched it grow to $1,000 a share over 40 years can pass that stock to their children with a brand new basis of $1,000. When the children sell, they owe nothing in gains. This is how generational wealth compounds without ever being taxed. Sixth, the Roth conversion ladder. You take money from a traditional IRA, pay the tax on it during years when your income is low, convert it to a Roth IRA, let it grow tax-free for 5 years, and then withdraw it completely tax-free. Used correctly, this lets high-income earners build tax-free retirement accounts even though they were technically above the direct Roth contribution limit for most of their working lives. Seventh, the research and development tax credit. If your business spends money on developing new products, improving existing products, testing new processes, or building custom software, you can qualify for a federal tax credit that can be worth up to 20% of those expenses. This is not just for pharmaceutical companies or semiconductor manufacturers. A small software company, a custom fabrication shop, a food and beverage company developing a new recipe, an engineering firm designing custom solutions, all of them can qualify. The average small business owner does not even know this exists. The average tax accountant does not know how to claim it properly, but the companies that do know have legally shifted tens of thousands of dollars per year out of their tax bill and back into their own pockets. Eighth, the backdoor Roth IRA. If you make too much money to contribute to a Roth IRA directly, you can still legally get money into one. You contribute to a traditional IRA on an after-tax basis, then immediately convert it to a Roth IRA. This is completely legal. It has been blessed by the IRS in published guidance. It lets high earners build tax-free retirement wealth that grows completely outside the reach of future tax increases. Every single year you can do this. In every single year, most people who could benefit from it never even hear about it. Ninth, the mega backdoor Roth. This is the big brother of the regular backdoor Roth. If your employer offers it, you can contribute up to around $46,000 per year into a Roth account on top of your regular contributions by using after-tax contributions that get converted or rolled over. This can supercharge your tax-free retirement account by hundreds of thousands of dollars over a working career. It is one of the quietest advantages in the entire code, and it only exists for people who bother to ask their plan administrator whether it is available. 10th, historic rehabilitation tax credits. If you buy and restore a certified historic building, the federal government gives you a 20% tax credit on the qualified rehabilitation expenses. That means if you spend $1 million restoring a historic property, you get $200,000 back as a direct reduction of your tax bill. Combine that with depreciation, cost segregation, and real estate professional status, and you can legally build a real estate empire around historic properties while paying almost nothing in tax. 11th, low-income tax credits. This one is not for the average person, but if you have the capital to invest, the government will pay you directly for building affordable housing. The credits can be worth up to 9% of your qualifying investment every year for 10 years. That means the government effectively pays back 90% of your investment in tax credits over a decade while you still own the property and collect the rent. This is why the largest private investors in low-income housing are insurance companies and wealthy families. They understand the math. 12th, Section 529 plans with Roth conversion. Starting recently, unused money in a 529 education savings plan can be rolled into a Roth IRA for the beneficiary up to $35,000 in total. So even if your children do not end up using all the money you save for their education, it does not get lost. It gets converted into a tax-free retirement account in their name. You can front-load a 529 plan early in a child's life, let it grow for 18 years, pay for their education, and then pour the leftovers into their retirement account. That is intergenerational wealth transfer with tax-free growth at every single step. Now, let me walk you through an example that shows how these stack, because this is the part that changes how you think about money forever. Imagine you are a business owner making $250,000 a year without any tax planning at federal plus state plus self-employment tax rates. You are probably handing between $80,000 and $90,000 to the government every year. That is more than 30% of your entire gross income gone before you even get to live your life. Now let me walk you through the same person using the strategies I just described. You put $69,000 into a solo 401k. You put $8,000 into a health savings account. You buy a $300,000 rental property and claim roughly $10,000 in depreciation. You do a cost segregation study and front load another $30,000 of depreciation in the first year. You pay your teenage children $12,000 each for real work in the business, moving $24,000 off your return into their zero tax bracket. You put $100,000 into a carefully vetted oil and gas working interest and deduct $80,000 of it. You use the Augusta rule and collect $28,000 in tax-free rent from your own business. Add up the deductions. You just legally erased around $240,000 of taxable income. Your effective tax rate drops from the mid-30s into the single digits. You just put somewhere between $50,000 and $70,000 back into your own pocket in a single year every year forever. All of it legal, all of it documented, all of it written into the code by Congress. And that is just year one. Now imagine that same person stacks those strategies year after year. The rental properties grow in number. The retirement accounts compound in a tax shelter. The HSA grows into a hidden medical war chest. The children grow up with real work history and real Roth accounts in their own names. The business becomes more valuable because it is being reinvested in aggressively. 10 years from now, that business owner has somewhere between $1 and $3 million in additional net worth compared to the version of themselves that did nothing and just paid the standard tax bill. That is not hypothetical. That is the math. That is what happens when you actually use the code instead of complaining about it. Now here is the part that actually matters, and this is what I want you to walk away with. The reason most Americans never touch any of these strategies is not because they do not qualify. It is because nobody ever tells them that the tax code is a menu of incentives. Your high school did not teach you this. Your college did not teach you this. Your employer did not teach you this. Your financial advisor probably did not teach you this either, because most financial advisors are trained to sell products, not strategies. So, the code sits there full of incentives waiting for someone to read it, and most Americans never do. Congress uses the tax code to steer money toward the activities they want more of. Businesses, housing, energy, retirement, education, conservation, charitable giving. Every single one of those categories has a bright green sign flashing next to it that says the government will pay part of the bill for you if you participate. The government is literally putting its hand in its pocket and saying, here, take some of this money if you will just do what we are asking. And most people walk right past the sign and complain about how high their taxes are. The people who build real wealth are not the ones who work harder. They are the ones who read the instructions. The tax code is the instructions. You just have to stop treating the IRS like an enemy and start treating it like a rule book. Because once you know the rules, you stop playing defense and you start playing the same game the wealthy have been playing for 100 years. And that is the game where the IRS actually pays you. And I want to leave you with one more thought, because I think it is the most important thing anyone can understand about taxes. Most people think they are paying taxes because they are being punished for being successful. They are not. They are paying taxes because they have not yet learned how the system was built. The system was built by people who expected you to invest in businesses, own real estate, fund energy, save for retirement, and build wealth. The system was built for active participation, not passive observation. The moment you become an active participant, you stop being a tax victim and start being a tax beneficiary. The IRS is not your enemy. The IRS is an incentive program dressed up as an enforcement agency. The sooner you see that, the sooner you start getting paid instead of paying. Read the code. Hire the professionals who know the code. Invest in the things the code rewards. Stop complaining about the system and start using the system. And remember, every single strategy I just walked you through is 100% legal, 100% documented in plain language in the Internal Revenue Code, and 100% available to you right now. As soon as you decide to start participating instead of observing, the IRS is waiting to pay you. You just have to learn how to ask for it. One last thing before you go. If nothing else you take from this video, take this. Every single wealthy family you have ever heard of got there by understanding one thing that ordinary people never do. They learned that money is not earned the way most people think it is earned. It is not earned by working harder. It is earned by positioning yourself inside the parts of the tax code that Congress subsidizes. $1 earned at a W-2 job is taxed at 40%, and then you get to spend what is left. $1 earned through business ownership, real estate, or properly structured investments gets taxed at 0, 10, or 15%, sometimes less. And then it gets reinvested and compounded for decades. That gap is the difference between staying where you are and building something generational. Make the decision today. Do not wait until next year. Start with one strategy. Implement it. Then add another and another. This is how real wealth is built, one legal tax advantage at a time.